This is the DeFi Decoded podcast by 9 Point Partners in cooperation with Prophecy DeFi. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello, and welcome back to another episode of DeFi Decoded. I'm Alex Tapscott here with co-host Andrew Young. We are going to take a little break from FTX contagion to talk about an interesting topic that has kind of come to light in the past week or so, and that's this idea of wrapped Bitcoin and wrapped Ethereum. Of course, both of these things are appearing, in the context of the news. There's some question over WBTC, wrapped Bitcoin in particular, because it has technically broken sort of below its peg a little bit in the last period of time. We're going to get into that and discuss maybe the reasons for that. But I think it raises a more interesting question amongst people who are sort of not deep in crypto, which is what exactly are these things? What is wrapped Bitcoin and wrapped Ethereum? We already have Bitcoin and Ethereum. What does wrapping mean? What does it do? What is its utility? What is it used for, and so forth? And with that, I think, Andrew, you're probably a good person to kick things off. So can you just tell us a little bit, like in layman's terms, what exactly are these wrapped products and how are they used in the ecosystem?
Yeah, so I'll start with wrapped Bitcoin. So Bitcoin is obviously, it's native to the Bitcoin blockchain. So there's no way to use Bitcoin on Ethereum. And so essentially what wrapped Bitcoin is it's a way to lock up Bitcoin on the Bitcoin blockchain. And then I believe BitGo is the custodian. They mint wrapped BTC on the Ethereum blockchain, which is an ERC20 token. So you can use it in the Ethereum DeFi ecosystem.
Right.
And then because it's an Ethereum ERC20 token, you can bridge it to other EVM chains like Avalanche, Polygon, all those different Phantom, all these different types of chains. So essentially what it is it allows you to use Bitcoin on other blockchains. The way it works, though, is kind of how I described it. It's not a native bridge. It is very much a sort of centralized bridge. Mm-hmm. There is essentially I believe it's an 11 of 18 multi-sig. So what that means is there's 18 different people who can sign a transaction. And if 11 of the 18 sort of agree with something, then then transactions can be processed. The risk with this is obviously if the majority of those multi-siggers are malicious for some reason, and they're mostly trusted entities within the space, then that's obviously a huge risk factor there. And the second is if the Bitcoin that's being custodied by BitGo, if that was to be hacked or exploited or stolen in some way, then the wrapped Bitcoin on the Ethereum blockchain would now be unbacked, and so the price would fall pretty dramatically. And so what's happened over the last little bit is 3 of the 4 biggest merchants of wrapped Bitcoin are, I believe it's FTX, 3 Arrows Capital, and Genesis. So these are all entities that are currently either on the verge of bankruptcy or in bankruptcy. And so this created a lot of fear that Bitcoin, the wrapped Bitcoin, perhaps had some sort of exposure to this. Mm-hmm. And like maybe the capital hadn't been held, but maybe it had been lent out in some way or off book. And so wrapped Bitcoin traded, it went all the way down to about a 2% discount relative to traditional normal Bitcoin.
Right.
And this was about a week, actually only about 4 days ago, over the weekend. It has since recovered because the BitGo team has done a really great job of sort of going through sort of explaining these different factors and why it's not possible. It turned out the whole sort of worries about them being merchants doesn't matter. I mean, it doesn't mean they custody the Bitcoin in any way. It just means they're a customer of it. And then second of all, I believe they put out a proof of reserves, which sort of showed that the Bitcoin was all there. And then finally, I think just the BitGo team has done a good job of sort of being very active on social media and talking to people and the result is that it's come back to pretty much right back to peg. So it went to a 2% off peg, and now it's roughly 25 basis points off peg, which is pretty much sort of where it normally trades.
Got it. And so we had Mike Belshe, the CEO of BitGo, on the show just 2 weeks ago, and he was talking about how BitGo works as a full reserve custodian. So basically, they're not lending out customer assets, and they're maintaining, balances on a 1-to-1 ratio, and that is true as well of BitGo. That's what they state, and obviously that's also the case, and that shouldn't come as any surprise. BitGo, I think, custodies like over $20 billion of assets on behalf of institutions and other market participants, and was even just recently chosen actually as the custodian for the FTX bankruptcy. So they're held in pretty high esteem, and so this comes as no surprise. But I think what's more interesting about that is the idea that Bitcoin is this sort of inert object. It's this thing that can't be used outside of the Bitcoin network, and being able to move and store Bitcoin peer to peer and anywhere permissionless between parties is a really powerful thing. But there's lots of other really interesting applications in Web3 for tokens, and what Bitcoin is in and of itself unable to sort of satisfy those rules, right? So it creates this interesting opportunity, but in the process, it also creates like a centralization point, and therefore sort of a pain point, so to speak, or a potential hacking point, or whatever you want to call it. With BitGo, no matter how sterling a reputation BitGo has, any centralized entity creates some level of vulnerability. Now let's contrast that to WETH, WETH or WETH, how do you pronounce that? But anyway, this is something that's also been in the news, and for reasons that we don't need to get into per se, other than people have been sort of joking about it losing its peg, but that's not something that's really possible, is it, Andrew? Can you explain why that is?
Yeah, so wrapped ETH, sort of a similar, I guess, use case to Ethereum, but it's actually a smart contract. So it's more, there's not the same risk factors that there is with wrapped BTC. It can't, if you just kind of look at the code, it's not possible that it's not possible that it could become unpegged. And so essentially the point of wrapped Ether was native Ether. You use it to pay for transaction fees and things like that, but it's not ERC20. So what that means, so it's not the ERC20 token standard, which makes it really difficult, if not impossible, to use in the sort of DeFi ecosystem. And so what happens is most people use wrapped ETH. They essentially, you essentially send your Ether to this wrapped Ether smart contract, and it mints you one wrapped ETH for every ETH you put in. And this allows you to essentially turn your Ether into a way that you can use it within the ecosystem, and also bridge it and do things like that. So so what happened?
This might be a dumb question, but just to understand, let's say you want to do something in the Ethereum ecosystem with a DeFi application. Why do you need a second derivative of ETH? Why can't you just use ETH itself?
So yeah, because all these DeFi platforms use, for the most part, use tokens, right? So they use other ERC20 tokens for collateral and all that type of thing. So so to make it makes it far more you want to convert Ether into a more standardized format, so you can also use Ether on the same sort of level playing ground that you're using these other tokens. You don't have to so it's just much easier to turn ETH into wrapped ETH. But what's funny about the whole wrapped ETH thing is that you can see all of the Ether in the contract directly. So there's no there's not the same transparency or any of those fears with wrapped ETH. And what's hilarious is that some sort of Ethereum focused developers, to kind of poke fun at the fact that Bitcoin's wrapped Bitcoin product was facing potential fears that turned out to be unfounded, but were a realistic fear. To poke fun at it, they just said, "Oh, wrapped ETH is also potentially going insolvent," and it was obviously a joke, but a lot of people started getting worried that it was actually true, just because it became this viral joke that multiple different Ethereum influencers sort of just parroted, because it was kind of funny to people that know that it can't actually happen.
Right.
And so then it kind of just took on a life of its own. And then suddenly there's articles being written. It's just, people had to put out apologies being like, I didn't realize people would actually believe this. And so it was kind of a parody that went viral.
Yeah, I mean, it's a parody, but it's also just like, to me, a sign of how insular the community is. It's like, let's make an elaborate joke about how this thing is depegging or is bankrupt. To what? Like own the normies, like to make other people outside of like this insular Ethereum community look stupid. Like at a time when this whole ecosystem is under scrutiny and people are questioning, its long-term viability and whether this can scale to the mainstream. You put on this like elaborate shtick to like make it seem like this thing is going bankrupt. I don't know. I think people need to get off the internet and like go do something with their lives sometimes. Like it just seems like such a colossal like waste of energy. But anyway, I think like, again, that's what I really think. If you want to like talk about like the what this all means, we've talked a lot before in the past about what makes blockchains interesting or Web3 interesting is this idea of composability, that different applications can interconnect with each other, and that you can also have like composable liquidity in by connecting all of these different sort of disparate pools of liquidity and users. You can actually have like kind of a global market in everything. But then you get into this problem of, well, different tokens are issued with different standards on different blockchains, and some like Bitcoin, which is like single use, doesn't easily transfer onto something else. So you've got to use these bridges and you've got to come up with these different kinds of solutions. And, that to me strikes me as like a big implementation challenge that needs to be overcome. So, are wrapped coins going to be a bigger part of our future, do you think? Or are we kind of come up with something else here?
Yeah, so I think wrapped coins are actually more and more of the future because I think what like as you have more and more L1s, you're going to get more and more sort of non-native wrapped tokens. And my personal opinion is we're going to see an explosion of L1s, and so that's going to continue happening. You can also think of like if a token's not on its native chain, then you can kind of think of it as wrapped in a way, because if something happens to the native chain, then it, you know what I mean? It becomes essentially unpegged or unwrapped. So as you add more and more bridges, because really the wrapped Bitcoin, you can think of it as a bridge. And so whereas wrapped ETH, they're both called wrapped, but I would very much put them in two different categories. I would really say wrapped BTC is more like bridged Bitcoin, whereas wrapped ETH is truly wrapped ETH. And so, yeah, so I guess there's going to be a lot more sort of bridges in the future, a lot more L1s. Each of these L1s will have their own sort of plethora of native tokens as well. And I think that's really what it shows, is that ERC20 and EVM is dominant by far. And really the only challenger that was Solana, which has obviously been sort of taking a hit due to the FTX stuff. So I think it's sort of cemented, to me, like a lot of this I believe there's actually far more wrapped Bitcoin on Ethereum than there is Bitcoin in the Lightning Network, which really goes to show you something, that Ethereum is still king when it comes to DeFi, payments, pretty much everything.
Yeah, I mean, it's obvious that like whatever, Bitcoin is really great at what it does, but it's like not programmable, and these solutions to try and do stuff on top of it aren't seeming to scale. Not yet. I don't want to say never say never, but at this point it just seems like that there's like a clear path to build stuff on Ethereum. And what's interesting too about this whole crisis recently is that a lot of Bitcoin maximalists were touting the benefits of earning yield on your Bitcoin using centralized platforms like BlockFi versus say, but then dismissing on-chain smart contracts or other entities like in Ethereum, where that didn't end up having the same level of like counterparty risk. It just to me is like kind of ironic. Sorry, that's a bit of a diversion. Go back. What were you saying?
Well, no, I think like, yeah, I mean, I just think like there's more and more L1s, each of these L1s are going to have their own sort of plethora of tokens, and it's going to lead to more and more sort of wrapped non-native versions of tokens,
right?
Which will actually create, in a weird way, Ethereum is replacing counterparty risk with protocol risk.
Exactly.
And as the
smart contract risk, or
smart contract risk, yeah.
Yeah.
And so as we add more and more chains and more bridges, that protocol risk actually gets magnified. Particularly if there's if we start having cross-chain loans and things like that. Like, we haven't really entered into that space yet, but it'll start to get really interesting. And yeah, I'm really curious to see what's going to happen. I mean, one thing that's also really interesting to see is there's a number of L1s that are getting started now that are rolling their own stable coins at the base layer. And
what does that mean exactly?
So they're kind of doing what Terra did, with perhaps more conservative sort of economics attached to it, like less aggressive in terms of how unbacked the tokens are. But I mean, we had Agoric on our show like a year ago. They have like a native stablecoin that's essentially collateralized with their underlying token or coin, whatever you want to call it. You have things like Barachain, which is sort of like a doing somewhat similar, is also creating, I guess, what you call leverage at the base layer with their own stablecoin, I believe. It hasn't launched yet, but that's sort of what's rumored to be coming down the pipeline. I mean, you saw Near Protocol did this with USDN, and then obviously Tron has done it with their own stablecoin as well. So I think the future is going to be, in a crazy way, Terra might not have been the beginning of the end. It might have just been the beginning in a series of different experiments with base layer chain leverage, because in a lot of ways, leverage only works if it's built directly into the base layer. So it's interesting to see, but I don't know what are your thoughts? Like you're obviously really plugged into the Cosmos ecosystem, and I mean, I'm just curious, like where do you think DeFi goes from here over the next kind of 12 to 24 months? Like, it's been as a prominent Twitter influencer, this guy Dejen Spartan says, we're in month 29 of a 36-month bear market in DeFi, just in terms of its relative performance against Ethereum. So for about 2 years now, DeFi has been underperforming Ether. Like, what do you think gets us out of this? I mean, there's all sorts of experiments coming down the pipeline, but I'm definitely curious to hear your opinion.
Well, I question the methodology that goes into that statement that we're in a 29-month bear market relative to Ethereum. I'm sure what he means is that like DeFi native tokens are underperforming Ethereum, but is that the best way to measure the success of DeFi? It's a separate question, right? DeFi is an industry, and so the valuation of tokens is only one of many metrics that you'd want to use. You'd also want to look at you'd want to look at TVL, and you want to look at like daily active users, and you want to look at general sort of momentum signs of growth in the industry as a whole. And I think that we're definitely in a bear market in all those things too, but those things have not been in a bear market for 28 months or whatever. They've been declining since around March, April. And in some instances, we're seeing some early signs of rebounding. Like you mentioned, Cosmos, like daily active users and Cosmos and Osmosis specifically, which is their DEX, are ticking back up to all-time highs, and have been for the past month or so. So that's, like, again, just one of many data points. I think, we're probably going to just see lots of experimentation on different platforms. I think, you're going to see like Solana and Cosmos and some of these EVM chains and others just see more and more sort of innovation happening. I think that probably the solution, such as it is, to like get out of this rut is going to be to solve some of those technical challenges about interoperability and composability. But I think probably the bigger opportunity is just to build useful stuff that more people want to use. I think that a lot of applications in DeFi and Web3 in general were built to justify the tokens. Whereas I think in the tokenomics, whereas in the future, I think that the tokenomics or the tokens are going to be a bonus to using the service. That ownership of community-owned platforms is going to be a nice to have, not a need to have. And that we're going to sort of get away from what I would sort of describe as the perverse incentives of a lot of early DeFi and Web3 stuff, which basically encourages people to hunt down yield and rewards where they exist and try to extract them as quickly as possible. And when that opportunity is dried up, just to move on to the next thing, without any sort of interest or consideration for using the underlying technology. And I think that that's something that will only come to pass when applications in DeFi and in Web3 are useful to a broad swath of people that, they want to, play blockchain games because they're fun, not because they're trying to earn token rewards, or they want to, use a DeFi protocol to move and store value or get access to credit because they want that to go do productive things in the economy, not because they're just looking to trade more coins. And I think that those are some of the big challenges, but also the big opportunities that exist for entrepreneurs in the space. And so I think that I wrote a piece for Fortune recently, just sort of making some recommendations for lessons to learn from this. I think that's the biggest one, which is that, try to build stuff that people want to use, not convince everybody that they've got to be trading tokens 24/7.
Yeah, I totally agree with that. I think, and just to kind of add to your point, I think the underlying economics and underlying idea of DeFi is still incredibly strong. I'm still a huge believer, obviously. I think it's just obvious that people want ownership in the projects that they use. And just given how completely opaque and just truly unfair traditional sort of financial systems are, and just how much of a closed garden they are. Whereas DeFi is fully transparent, everything is sort of democratic, and it's a totally open garden with everything being open source. So it's really a developer's paradise in a lot of ways.
Yeah.
I just think that makes.
Sorry, go ahead. Yeah, I think all those things are true. And so let's lean into those strengths and continue to innovate along those lines and in other areas of finance and in other maybe new areas of frontiers of technology, however you want to describe it, that you can drive mass user adoption.
Yeah, exactly. And so I think I'm not sure what will happen over the next little bit. I think taking a step back, having been in the crypto space now for, I guess, 6 years, it seems like everything revolves around the Bitcoin halving. I don't know why, but it seems like we're in our own mini 4-year cycle every time. It's now happened sort of 3 cycles in a row. And so if you kind of follow that logic, there's about 16 months until the next Bitcoin halving. So I guess that's the next big catalyst, because I would have thought the Ethereum merge would have sort of got people excited, and it definitely did, but it just seems like the rubble from Terra Luna, Three Arrows, FTX, and now sort of Genesis and Digital Currency Group. There's just too much, and so it's going to take a while to sort of clean everything out.
Well, it's a deleveraging. Like Ray Dalio talks about deleveraging and how sort of the response to the global financial crisis sort of forestalled the deleveraging and maybe even made it worse by increasing leverage. And what's interesting about crypto, and it goes back to some things we were talking about in the summer, is that there is no lender of last resort. So there's no like theoretical bottom, so to speak, other than zero for any asset. But that also means that it generally tends to like churn through crises fairly quickly. Like in the end, if DCG, for example, is unable to raise capital to fill this hole, it'll go bankrupt. Like there's like the Federal Reserve is not going to rescue it or something like that. And then there's going to be a bunch of assets that are left behind, and then some people will go and acquire them and then, go put them to good use doing something else, or maybe not. And that doesn't, I'm not trying to be glib, like some people will lose their jobs and asset prices might suffer, and that might be bad in the short term. But, in the long run, that's sort of the way this thing works, right? And I think that, this bear market that we're going into, I think hanging your hat on sort of on-chain factors like merges and halvings and so forth is not like I guess that might mean something, but to me, that's like a social and psychological milestone than any actual kind of like mathematical law of nature. It's not like when the halving happens, all of a sudden, that means that Bitcoin therefore will go higher. It does mean that the stock to flow will look better. It'll take even more years to replace the current stock at the current rate of inflation, and that's typically a sign of a strong scarce asset. But only if people continue to use it and if they continue to want to use it, right? So I think those are the more important things to me. Is that do you like putting these assets to work, using the underlying technology, driving new people, driving new businesses, enterprise adoption, all of these different of public blockchains, all of these different things are going to be really critical to the next era of growth. Like I think, preying on like hoping for, ether to become deflationary or deflationary or something like that as some sort of like magical elixir is not in and of itself going to work, in my opinion.
Yeah, makes sense. And yeah, I think, it's still something that I'm more just saying that I don't even know if it makes sense, but it seems to correlate with how things, I guess what I'm trying to say is that it does seem like crypto has this 4-year cycle that's sort of independent from anything else. And so even if macro improves and things improve, I'm not sure it's going to really impact crypto too much, which is kind of an interesting, I guess I'm more just succumbing to the fact that I think crypto for some reason is just locked into this 4-year cycle every time, but that might just be retrofitting on a sample size of 3. So
yeah, exactly. It's like you have these 3 examples of this happening. Does that mean that, assuming like, by the way, like it sounds
the law of nature.
Sounds like I'm bearish, but I'm not. I'm just simply saying that, there's a lot of like hard lessons that need to be learned from the past cycle of which was largely geared around capital markets, trading type applications and built on a lot of leverage. And so the next time around, I think it's just got to be a bit different. But I also agree with you that like, if you think this is going to keep going and grow and become, foundational to the next era of financial services, let alone, the next era of economic prosperity and whatever, then I don't know if we can extrapolate from a sample size of 3 to say that like in 100 years, will we be going through 4-year cycles? Maybe. I mean, it's certainly possible. There was a time in the financial world when panics and booms and busts happened every 4 to 7 years before the Federal Reserve stepped in, but that's a whole different subject for another time. But it could possibly turn out that way. I just think that it's a little too early to tell.
Yeah, I agree.
Yeah. Anything else?
Nope. That's
me neither.
It's been a crazy week. I mean, it's just been nonstop bad news for the last 6 weeks. So it's been pretty crazy, but I think it seems like we sort of exhausted the bad news the last week because people started pointing out to things like wrapped ETH and wrapped Bitcoin, which is just kind of like smoke when I don't think there is smoke. I mean, I say that now, and who knows, maybe a week from now, wrapped Bitcoin is all gone and it was all a lie. But I think it was mostly just, it's almost at the point, we're at the point of the cycle where everyone is looking at everything. There's no trust left.
Yeah.
Which is kind of an interesting part about crypto. I mean, these down cycles are so fast and so vicious. There's no other asset class where pretty much every time there's a downturn, it's a 90% downturn. You know what I mean? That's pretty unique within crypto. And also just in terms of the magnitude of the decrease, it typically happens within 6 to 12 months. And so I don't know where we are in the cycle. And I think like, to me, I would kind of expect 12 months of just nothing really too crazy on either side. And then maybe things start to pick up the following year, but it's definitely been interesting to see. Just kind of, it does seem, I guess, from my vantage point that we're now just looking for anything to get scared about.
Well, if our listeners want a little bit of hopium, the drawdown sort of from the peak to trough has taken about as much time as the last cycle in 2017, 2018. That market bottomed out in December of 2018. and ended up reaching two highs about 24 months later. Now, what happened in that 24-month period was that those lows were tested over and over again. And so, accumulating now, if you've got a sort of long-term view, we think is obviously, reasonable, but just be prepared for, long stretches of not only, volatility, but potentially just no sort of big directional moves, right?
Yeah.
Just a lot of choppy trading as the market sort of finds a level as we unwind through all this leverage. We hosted a great, well, just I'll plug one more plug, which is if you go to the 9 Point Partners YouTube channel, you can check out a webinar we hosted where we answered Q&A from our investor clients, mostly, advisors here in Canada. And they asked tons of great questions. And so probably if you have questions about what's going on, if we haven't addressed them on this podcast, there's a good chance they also got answered on that show as well.
Yeah, totally agree with what you said. I think that's probably market consensus is chopped for 12 or so months. And then we'll see what happens after that.
Yeah. Okay, Andrew, great chat as always. That was really interesting. I think I learned a little bit about some of these wrap products, and I'm sure our listeners did too. And despite saying we weren't going to get into the news and what's going on in the world, we did anyway, because you can't help ourselves, honestly. But it was great chatting, and we'll see everybody next week. We've got a great guest, Sid Powell from Maple Finance, is going to be joining us for a discussion on the future of DeFi lending. And I think that's something that a lot of people care about. So check us out next week. Take care.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.